Hello and welcome to Let's Talk Business. I'm Priyanshi Sharma and let's start with the updates from the Dalal Street. While Nifty and Sensex ended the day in red after a choppy trade today, sectors like tech, banks dragged the index the most. BQ Prime's Hiral Dadia is here with the market action.
Markets actually snapped the 3-day winning streak in today's session, and as we know, it was weekly expiry as well, so the volatility was pretty high. Nifty ended below the 18,700 mark, whereas the Sensex fell almost little over 300 points in today's session. It was mainly the financials which were a drag. However, an interesting move that we witnessed with regards to the pharma majors, specifically the hospital counters as well. So the likes of Fortis, Apollo, some smart moves coming in there on the back of a brokerage note with these names. Moving on, if you see in terms of the broader markets, clearly you had the mid-cap index which saw gains of around 0.3%, whereas the small-cap index ended pretty much flat. In fact, clearly the bank Nifty actually underperformed the benchmark indices in trade today. The analysts are of the opinion that this consolidation is something that will continue. There is good amount of resistance that the markets have been facing, and there is an absolute possibility, I would say, that we would not probably see life high levels in terms of Nifty 50 in the current expiry. That's what one of the analysts that I was talking to indicated as well. Let's quickly look at the top gainers. Apollo Hospitals, Divis Laboratories, DRL, Cipla, as well as BPCL. These were the top gainers in trade today, whereas on the losing end, you had a Hero Moto, Indocent, Wipro, SBI, as well as Kotak. Talking about the newsmakers, you have Titagar Wagon and BHEL, who signed a 24,000 crore rupee contract. So both these counters were in focus. GR Infra Projects was in focus on the back of an order win. Apart from that, Patanjali, BCL India, as well as AWL were in focus because the Ministry of Food and Public Distribution have said that the consumers will pay 5% less for edible oils. Cochin Shipyard, again on the back of an order win, saw good moves. Godrej Properties has announced an acquisition of land parcel for a luxury project in Kolkata, saw some good moves. SJVN on the back of an energy deal actually jumped to a 6-month high, as well as Warren Beverages saw smart gains as it was record day of on terms of the face value split as well. So overall, a lot of movers and shakers in trade today, but the consolidation in markets is something that the street is watching out for. Back to you.
Meanwhile, the US Federal Reserve left interest rates unchanged. It maintained a hawkish stance and signaled that it could go for at least 2 more interest rate hikes this year. Remember, the central bank's decision to hold rates steady in the month of June ends a run of 10 straight hikes undertaken to combat mounting inflation. Meanwhile, the Fed chairman in his briefing emphasized that the inflation still remains elevated, reiterating the inflation target at 2%. Listen in.
The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the 3-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year, and next year will contain a good amount of disinflation from that source. And that's, again, probably going to come slower than we would expect. That leaves the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services. And we see only the earliest signs of disinflation there. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions.
So with the Federal Reserve pausing the interest rate hikes, Bank of America's Izumi Devaluer says that there might be further hikes if the data for inflation and the labor market comes in hot. Remember, inflation is still around 4% above the Federal Reserve's 2% target. While speaking to BQ Prime's Neeraj Shah, an economist added that the Fed might be satisfied with the current interest rates, but it has to be more watchful of inflation. Listen in.
I do think that going forward, they are truly data dependent. So if the labor market and inflation data continue to come in hot, we think that further hikes will be delivered. Our base case is 2 more hikes in July and September. However, if we do see some further improvement and softening in the labor markets and inflation comes down faster than we expect, we think that they'll just pause here for the time being. One of the very important missions that Chair Powell and the Fed wanted to accomplish in this meeting is to deliver the pause without having markets, price in rate cuts. I think the Fed is fairly satisfied with where interest rates stand right now and the level of tightening that is being delivered through monetary policy. However, we still have inflation above target, so there still needs to be some work done to bring demand and inflation down. So what the Fed does not want to see is for the markets to price in premature cuts, for that to lead to a loosening of financial conditions, which may lead to a reacceleration in the U.S. economy.
And meanwhile, BFSI and CapEx plays will drive earnings growth going forward. That's what Nitin Shahbag of Motilal Oswal Private Wealth says. While speaking to BQ Prime's Neeraj Shah, Shahbag predicts that the automobile sector will play an important role as the growth potential remains intact.
At the end of FY18, if you look at the Nifty pool of banking stocks, the profit pool was around 45,000 crores. Today, at the end of FY23, it's grown up 5 times. So 5x in 5 years. It's gone to about 2.1 lakh crores. Every cycle, as you rightly mentioned, Neeraj, has a different set of winners. So maybe the sectors remain the same. At least 2 of the sectors we believe can continue to drive that trajectory. Commodities is way too cyclical to call. We've seen a lot of cyclicality even over the last few years. FY20, you saw commodities. FY21, there was a big rally, and then there was a drop, post that. So very difficult to take a call on commodities, but I would certainly assume that banking for sure. CapEx, more driven by PLI. We haven't seen broad-based private CapEx yet in terms of greenfield projects. But at least whatever has been decided through the PLI is certainly happening. So actually from a CapEx perspective, all the 3 aspects of CapEx are actually coming together right now, which is your public CapEx driven by the government, you have private, which is companies, and then you have household CapEx, which is really real estate. So these 3 are coming together in a right kind of frame. So I do tend to believe that they will lead the pack of earnings going forward, obviously along with BFSI. And I think the other sector which could do fairly well could be auto. Auto is also coming off a 5-year trend of downgrades in terms of earnings. So FY23 really saw a massive upturn. In fact, if you see calendar year till date, from amongst the top performing stocks, at least 3 to 4 names are within the auto sector. So I do think auto should play a reasonable role, at least over the next couple of years.
Yeah, and the other fact, Neeraj, is that balance sheets have got deleveraged over the last 5-6 years. If you see the net leverage, if we do this at a top 500 company level, has come down to 0.5, which means that the private capex, there is a lot of capacity for companies to do capex, and banks are also really eager to lend again.
That's all we have for you in this segment of Let's Talk Business. Thanks very much for watching.